Welcome to Breaking Bread Presents Gaps. I'm super excited to make this video. You don't know, I love a good gap play. All alerts on my charts are set on those gaps. I love a good gaps, and hopefully you will after going through this video. But in this video, I'm going to go over the basics of how to find high probability setups on these gap plays. A quick disclaimer before we begin, this video is for training purposes only. I am not a financial advisor. I'm just sharing with you the tools and ideas that I use when day and swing trading. So you assume all risk when using these tools and ideas that I share with you when you are trading. Gaps. Let's go. All right, so quick quote before we begin. The greatest gap in life is knowing and doing. Now, I take this to mean you can know all the information in the world, but what are you going to do with that information? How are you going to use that knowledge to make you and your family lives better? How are you going to make the world better? Always say knowing is the easy part. It's the doing part where we most fall off at. Now we can fall, but we're going to get up and we're going to use that knowledge and we're going to share that information. Don't stop. All right, so gaps. In this video, what are we tackling? We're going to talk about what gaps are. I'm going to talk about the types of gaps, the reasoning behind them. All gaps aren't created equal. We're going to talk about the gap and fade and the gap and go. We're going to talk about gap fills, same day, and minding the gap. So let's start off with what are gaps? So gaps are created when a stock opens up at a different price than where it closed the previous day. So even though gaps can occur on any time frame throughout the day, in this video, we are going to focus on the gaps created in the after and pre-market hours. So we're going to be talking about when price gaps up and when price gaps down. So what is a price gap up? I'm glad you asked. An example of price gapping up is what you see here. You see price on the day chart. It closed down here and it opened here. And it created this gap in between the price, which is this space here. So this space is the gap that we speak of. So it's a gap up because we were down here and price went up, creating a gap up. So that's a gap up. Well, what is an example of a gap down? Man, you are asking great questions. A gap down is what you see here. Price closed up here and open down here, creating a gap in between price, which is this space here. So this is the gap that we speak of. Why is it called a gap down? Because we opened here and price went down. So that's a gap down. But why? Well, let's discuss it. So there are different reasonings for price to gap up or gap down, but here are a few examples. So news. This information that is unexpected and sudden, such as natural disasters, wars, merger, product launch. And then you have analyst recommendations, your upgrade and downgrades. Sure, you heard of that before, but something being upgraded to a buy can cause a gap up in price, and something being downgraded to a sell, you can see price create a gap to the downside. Then you have your earnings. These reports are released quarterly or sometimes annually. But these reports can exceed expectation, causing price to possibly gap up, or miss expectation and price can possibly gap down. And you have your economic reports, which is your employment reports, GDP data, CPI, PPI. Those are just a few examples. So all gaps are not created equal. Things to ask yourself when looking at a stock gap up or down when the market is closed are how big was the gap created? Now, I found that gaps that are created and is more than 10% in size can present exhaustion and price will chop around until buyers or sellers want to step in and be a part of the action. Be mindful that 10% is based off the difference between the price of the gap. Also, during my back testing, a gap that is more than 10% is rarely, I mean, it was so rare to find a gap being filled within the same day or within a couple of days of that gap being created. Not saying it didn't happen because I did find a few, but it's a very low probability of that gap being filled. So who was in control before the gap was created? Was it buyers or sellers? So let's say for an example, we're in crowd, ticker CRWD, which is in a clear downtrend. And let's say price gaps up because of unemployment numbers. Do you think the sellers from that clear downtrend has just disappeared? No, they're still there. So this play is something I would keep an eye on for a same-day gap fill, which I'm going to talk about later in the video what that is. But you want to look for this to be a same-day gap fill back to the downside. Does the information that was released have direct impact on the stock? So again, let's say we are in crowd, CRWD, in a clear downtrend before the news came out. But this time it was earnings. It was earnings that came out from their company. Earnings came out and they beat earnings, which is news that came directly from that company. So price gaps up. So those people that was in a clear downtrend, meaning puts, before earnings are now stuck until price wants to come pick them up or they close out those contracts. So you want to compare the type of news versus, versus the first example where the news came out was unemployment numbers, which is not news directly produced from that company, versus earnings, which is news produced from that company. So was price at a previous level of support or resistance before the gap was created? I have an example of what I mean when I ask you this question, but you want to see when you see price approach a previous key level of support or resistance multiple times, often you will see price sometimes gap up or gap below that level. But I'm going to show you an example on that later on in the presentation. All right, so let's talk about my favorite, the gap and go and the gap and fade. The gap and go, what is that? That is when price gaps up after hours, then price continues to go up. The gap and fade is the reverse. This is when you see a downside gap created and price continues in the downtrend. So when you see that, you want to ask those previous questions that we stated earlier, and the more things in your favor, the higher probability to trust this play to continue. So let's look at some examples. Here you have NVIDIA. NVIDIA created a gap. It was down here, closed down here, it opened here. How big was this gap? This gap is way more than 10% in price. Who was in control at the time? Buyers. So that's in our favor for this to continue. It's more than 10%. That's in your favor for it to continue. What was the news? This news was based off earnings. So that is a direct impact from the stock, right? That's news directly from this ticker, NVIDIA. So was it at a previous level of support and resistance? I only care about the previous level of support and resistance when the news is not based off the ticker. So if it was unemployment numbers, things of that nature, then I care about previous support and resistance. But when it's earnings, I don't even care about that. All right, so we had buyers clear in the uptrend, check. Price gapped up, check. More than 10%, check. This is a high probability setup based off my strategy I'm going to use to get into this play for the play to continue to the upside. Also, like I told you guys earlier, when a gap is more than 10% in size, one is very rare that gap got filled. Also, it's going to chop around until people want to join the action of this play. And as you see here, it chopped around before it took off again. So be mindful of that when the gap is so large. Like this represents exhaustion, and then it needs people to get into this play to move it whichever way it's going. But that's an example on NVIDIA. Next example here we have Enphase. Now this is a high probability to take this play for continuation to the downside. This is what we call our gap and fade. Who was in control at the time? It looks like sellers before the drop. Is the gap bigger than 10%? Yes, it is. The news that came out, it was solar news, which was released, and which is a direct impact on the stock. So that's three things in our favor already. And again, I don't care about the previous level of support and resistance because the news that came out was a direct impact on the stock. So more than 10%. Price starts to chop around, waiting for people to join the action, and then we should take off again, but we shall see. It hasn't done it yet, but It's a high probability it's going to keep dropping, but we'll see. We'll play what we see. Play what we see. All right, so here we have an example of CVX, which gapped up based off unemployment numbers. So you see it closed here on the day chart and it opened up here. Now this is an example of price being at a previous support or resistance level. Here, you look at the purple line, it was a clear resistance level. It came to this level multiple times and rejected. Came, rejected, came, rejected, came, rejected, came, rejected. So this is a level of clear resistance, right? And price gapped up. So when I see price gaps above a level, that's an example of a gap and go. It got over this level that it was having a hard time to get over, and it continued up. So that's a thing in your favor. Who was in control? Buyers was clearly in control before this chopper round began. Is the gap more than 10%? Nope. So that's not in your favor. But buyers was in control. It was based off of unemployment news that it went up, and it was a previous level of support and resistance. So that's a high probability for this to be a gap and go play, continuation to the upside. All right, so what are gap fills? Gaps are considered to be filled when price retraces back to the level where the gap was created. Now, based on data, it is a 90 to 95% probability that all gaps in the market will be filled. When? No one knows that information. But when you see price approaching a gap, you want to keep an eye on that gap fill. So same day gap fill. These are gaps created when the market is closed and are filled when the market next session takes place. So if price gaps up or down after market or pre-market, then we want to see price fill that gap created with the whenever the next opening bell rings. So if a gap is created pre-market, we want to see that gap get filled that same day. So an example of same day gap fill. Some things to keep in mind for some possible same day gap fill are the pre-market levels, where a price acted as support and resistance, depending on which way the gap was created. So here you see price close down here. It opened here. You have your pre-market high, your pre-market lows, and then you have a clear level here of resistance. So you want to mark that. When you see that, that's what you want to mark. So price would have to get over this level for me to think that this is going to continue calls, because it clearly had a hard time getting over this level during pre-market. So was the gap created less than 10% or more than 10%? It was less than 10%. Who was in control at the time? At the time, it was buyers. The news that came out, crowd got upgraded. Was it at a previous level of support and resistance? It was at a previous level of support and resistance. And I'm going to show it to you real quick. Let's go a slide ahead. You can see here, this is the area we were speaking of. And if you look to the left, this was a previous level of resistance. So price gapped up to that level. So this is the second purple line. So price gapped up to this level. So this is a strong level of resistance. So I would need price to get over that level for me to believe that this would be a gap and go play, but it didn't. So now this became a same day fill, because price came down and started filling this gap that was created during pre-market. So this was getting filled. As you can see, candles is coming down, filling this level. It got back down to where it started. So now that's the same day gap fill. So you can see, again, like I said, price gapped up to a previous level of support, which is the purple line here, the second line, right? It gapped up there, and that was a previous level of support and resistance. So, and knowing that, that's a higher probability if it doesn't get above that line, to take this to the downside. because that was a previous level of support and resistance. So you want to keep that in mind. Also, something that you want to do for same day gap fills is you want to throw your fib on the gap. So my first target would be this 50% level. So find your fib tool and connect it from wick to wick. So this is a clear uptrend. So we're going to go from the top of this wick to the bottom of this wick. And you want to see your 50% level and your 0.618 level. Price tends to react to the 50% and the 0.618 level on these gaps. So you want to make that your first target if you want to. That's what I do. I play it to the 50% because majority of the time, price will get to this 50% level and start to retrace. Or price will get to the 61.8 level and start to retrace. So I take some profits here and I let the rest run and let price do what it wants to do. But that's just a recommendation. You don't have to do that. But I promise you that 50% and that 0.618 level, price loves it, and it'll start to retrace back in the opposite direction. So minding the gap. So when you hear this, mind the gap. That is making you aware that price is approaching a previous made gap. These types of gaps act as previous supports and or resistant levels. So you're going to want to play these type of gaps a little differently than the ones we spoke about earlier in the presentation. When you see price approaching a previously made gap, ask yourself, has price retraced yet? And is this the first time price has come to this gap? But why? Well, let's discuss. So after all my back testing, it is a low probability that price will approach a previously made gap and fill it without some type of retracement first. So it's a low probability setup if it hasn't retraced first. And it's a trap. This is how they trap people because they know once you see price approaching a gap, you're more than likely to hop in that play for a possible gap fill, thinking it's going to fill that gap. And what does it do? It turns around and go retrace. So the market knows when price is approaching the gap. There's a higher probability you are going to get into that play for the gap fill. So a high probability setup for a previously created gap is to catch your retracement back to the gap. So you want to see price retrace before you even try to think about getting into playing that gap fill. So here's an example of Roblox. Here you see price gap down based off news that came directly from the company. So as you can see, price appeared to act as if it was going to fill this gap for, what's this, 4 days straight? 4 days in a row, it acted like it was going to fill this gap. So I'm pretty sure people got stuck in this play for calls, thinking it was going to fill this gap, but it didn't. And as you can see, the bottom of this gap acted as a level of resistance. So buyers couldn't get this price above that level. So I look at these retracements as price going to get gas and trying to fill that gap. So it has to retrace before I want to get into this play. So once I start seeing price come back up, then this is where I will get into this play for a possible gap fill. As you can see, it came back up to this line of resistance, which is the bottom of this gap. It did not create a newer high, but that wasn't enough gas for it. So it's about to retrace and go do it again. It retraced. This time it came back up and it broke through. It made a new high, even a newer high, but then that wasn't enough gas. So it came back out and retraced again. You're gonna see this often with with minding the gap plays. Like it'll get in the gap, come out the gap, go back a little deeper in the gap, come all the way out the gap. You're gonna see that often. But I look at these retracements as price going to get gas to go back and attack that gap. So you want to make sure you're on the retracement side of the gap fill, not the first like this. You don't want this. That's not a high probability setup. You want some type of retracement before you want to get into this play. And you want to take it back up to the gap and see what it does, because you never know which time is going to fill this gap, but you just want to be on the right side of the retracement. Here is an example. What is this? Marvel on the day chart. You see price gapped up. This Closed down here, open here, created this gap in between. Let's look at it. Price continued to go, came back down, got people stuck in here. It retraced, had to go get some gas, came back in, creating a newer low. Still wasn't ready, came back out, retraced, came back in, didn't take out this low. We got to go get some more gas, played around with it. We got deeper in it, creating a newer low. Wasn't enough gas, so we got to go pick some more people up. Came back in it. This time it gapped down further into the gap. And what did it gap down to? 61.8, 50%. That wasn't enough gas, so we came back out this gap. Went and got some gas, came back in, and we just got deeper and deeper. So you just want to make sure price has retraced before you even think about getting into a gap play of a gap that was previously created. Right? This is not a same day gap flow. These are gaps that was previously created in the past. So you want to make sure you're in on that retracement side. Not this first touch is not what you want, because like I told you, it was a low probability of this getting filled. So you want to make sure if price retraces and then play the retracement side of it. Price retrace, this is the side you want. Price retrace, this is the side you want. All right. So none of this matters at all. I mean, this doesn't matter at all if your mindset is not on point. I would say trading is 90% your mindset and 10% technical analysis. You can definitely become one of those lucky ones who can get by without building your discipline and your mindset up to be successful, but you're only setting yourself up for short-term success. With trading, you want to be okay with things that you can control and things that you cannot control. If you can't accept this, this is going to be a difficult journey for you. The quicker you can get there, the easier this trading thing will become. So what do I mean by things that you can't control and things you can control? So things that are out of your control are things like news, volatility, unexpected news, which way the market trends off of unexpected life events. Like you can't control the market. The market is going to do what the market is going to do. I'm sure we've all been in plays and it's in our favor, and then news will come out, and then all of a sudden we're down in the trade. Like you can't control that, and you have to accept that it's a possibility that that may happen. So you have to accept, okay, when going into this play can definitely go against me. Now I'm okay with that. And mentally, you have to be okay with that. Things that are in your control would be your technical analysis, putting that plan together of your entries, your exits, your timing, your position size, your risk management, your mindset. Like we all know that the market is going to do what the market wants to do. All you can do is create a plan and stick to it. So you want to create a plan that sticks to your strengths until you're able to build discipline to combat your weaknesses. What does that mean? That means, let's say, your patience is something you struggle with. Then create a plan to where maybe scalping is a better option for you until you can grow your patience. Your goal is to be on the right side of what the market is doing. And if you find yourself in places that are on the wrong side of the market, then stick to your exit plan, right? You get into a play, it's not going the way you thought it would go. Get out of that play. It's okay. It's okay. It's okay. Like don't stay in that play. But like, oh, it's gonna come back and hoping and wishing. There's no hoping and wishing and playing. We're only going to do what the market is telling us it's doing, and we're going to adjust to the market. The market doesn't adjust to us. It's okay to take red plays. Red plays come with trading, but what we don't want is red days. So we want to shake that red play off, go find the next play, wait for it to set up, and execute. That's it. All right, some quick tips before we get out of here. You want to know the reasoning behind the gap. Was it news? Was it earnings? Was it analyst recommendation? Was it an economic event? You want to know who was in control before the gap was created. This is extremely important if the reason behind the gap has nothing to do with the stock directly. For example, something clearly in the downtrend and price gaps up because of unemployment numbers. Watch this for a possible same-day gap fill. Those sellers did not go anywhere. Yeah, unemployment news came out and gapped it up, but those sellers are still there. So you want to watch that for a possible same-day gap fill. Same-day gaps is it mind the gap? So same-day gaps, you want to know who was in control and what was the news that caused the gap to happen. Was it direct news from the company or was it unemployment numbers? Minding the gap, you want to make sure you're asking yourself, is this a retracement? Is this the first time price approached this gap? If it is the first time price approaching this gap, don't touch it. You want to catch it on the retracement side when it's a previously made gap. And you want to have a full plan in place before taking a play. So what's your entry? What are your targets? And what is your exit plan if this play goes against you? Every play is not going to go in your favor, but you want to make sure you have that full plan in place before you get into play. And most importantly, your mindset is everything. Accept what you can't control and accept what you can control. And you will be the trader that you want to be. If the play doesn't go in your favor, just exit the trade. Shake it off. Look for the next high probability setup. That's it. I hope this video provided some useful information on gaps and what to look for. I look forward to part 2 of this video where I will dive deeper into gap plays. Like I always say, it's either going to work or it's going to work, and that is the only option. If you have any questions, feel free to drop it in the comment section below or DM me. I truly want to see us all win, and we will win if we just keep going and don't stop. But until next time, thank you for breaking bread with me. You guys stay blessed.